Silver just crashed from 91 to 85. $6 gone today. And if you're sitting there watching your portfolio bleed, your first instinct is probably to panic, to sell, to think the rally is over. I need you to stop, because what I'm about to show you is going to completely change how you see this crash. By the end of this video, you'll understand exactly why silver crashed and who did it, and why I believe this is one of the best buying opportunities we've had in months. I was going through the data last night, and I found something that stopped me in my tracks. The CME, the exchange where silver futures trade, stopped trading yesterday. They halted the entire metals market. Gold, silver, copper, natural gas, everything shut down mid-session with no warning. And the explanation they gave was technical issues. I don't buy it. And by the time I'm done walking you through the data, I don't think you will either. Hey, James here. This is Noble Metals. We cover silver and gold with raw data. No fluff and no panic. If that's what you need right now, press subscribe button. Let's get into it. Silver's recent price movement surprised many investors when the price dropped from 91 to 85 within a short period. On the surface, this may look like a simple market correction, but when analyzed in the context of futures market, expiry cycles, and trader positioning, the situation appears more layered. Rapid downward movement often triggers fear among market participants, especially those using leveraged trading strategies. Historically, silver has been one of the most volatile major commodities, where multi-day or multi-week swings of 5–10% are not unusual. However, when such movement occurs near expiration windows, speculation naturally increases. To truly understand the market, it is not enough to only observe price charts. Investors must also evaluate liquidity conditions, trader behavior, position rolling activity, and market depth. Emotional responses are common during sudden drops, but disciplined analysis is more reliable. Silver futures trading primarily takes place on the Chicago Mercantile Exchange, particularly through its COMEX division. The futures market operates on standardized contract sizes, where most participants are not interested in physical delivery, but instead trade for price exposure and hedging purposes. As expiration approaches, traders usually close their contracts or roll them into the next month's contract. This rolling process can sometimes create temporary liquidity pressure, especially when large institutional positions are involved. High open interest levels do not necessarily indicate physical demand for silver. Instead, they often represent speculative or hedging activity. When many traders adjust positions simultaneously, market microstructure effects can produce sudden price volatility. Such behavior is a normal part of futures market functioning, rather than evidence of abnormal market control. The COMEX Vault inventory system is divided into two main categories: registered and eligible silver. Registered silver is considered ready and available for delivery if a contract holder requests physical metal settlement. Eligible silver, on the other hand, is stored inside vaults but is not officially marked for delivery unless the owner authorizes the change. When registered inventory decreases, many market observers start discussing shortage risks. However, inventory movement between categories is common and should not automatically be interpreted as supply crisis evidence. Metal can move from eligible to registered status whenever delivery demand increases. Therefore, focusing only on registered inventory numbers may create incomplete conclusions. A comprehensive analysis should include total vault holdings, delivery notices, and open interest ratios before forming any structural risk judgment. Gold and silver maintain a historically strong relationship, but they do not always move in perfect synchronization. Gold is primarily viewed as a monetary safe haven asset, while silver serves both monetary and industrial roles. Because of this dual nature, temporary divergence between gold and silver prices frequently occurs. During risk-off market conditions, silver often experiences stronger selling pressure because its price behavior tends to have higher volatility compared to gold. Market correlation between the two metals is not constant and can change depending on macroeconomic conditions. Therefore, short-term divergence between gold strength and silver weakness should not automatically be considered unusual. Many historical trading cycles have shown similar behavior during liquidity adjustments and portfolio rebalancing phases. The influence of large financial institutions is often discussed when analyzing precious metals markets, especially companies such as JPMorgan Chase. These institutions often participate as market makers, liquidity providers, and hedgers, rather than purely directional speculators. Their published research reports usually present long-term macroeconomic scenarios, rather than guaranteed price targets. Many readers mistakenly interpret scenario analysis as official price prediction. Institutional participation does not automatically imply market manipulation. Claims of systemic price suppression require strong empirical evidence, such as delivery failures, legal enforcement actions, or emergency market restructuring events. Price volatility alone cannot be considered proof of coordinated control. Financial markets naturally exhibit periods of high volatility due to complex participant interactions. Trading halts in financial markets often generate significant speculation and emotional reactions among investors. However, halts are typically triggered by built-in risk management mechanisms designed to maintain orderly market conditions. Technical system issues, extreme order imbalance, or sudden volatility spikes can all trigger temporary suspension of trading. If multiple metals are halted simultaneously, infrastructure or system-wide risk protection mechanisms become more likely explanations than targeted market intervention. In genuine systemic crisis situations, clearinghouses usually release official emergency statements, adjust margin frameworks, or modify settlement rules. Historical financial market events show that exchanges prioritize maintaining market stability rather than allowing disorderly price discovery. Without strong structural evidence, temporary halts should not be automatically interpreted as signs of hidden market control. Silver has historically exhibited strong multi-cycle volatility, sometimes experiencing price swings between 20% and 30% over several months. Several macroeconomic variables influence silver pricing, including U.S. dollar performance, real interest rates, global economic sentiment, and industrial consumption trends. Chinese manufacturing and renewable energy technology demand play an important role in global silver consumption patterns. Expiration weeks can amplify price movement because speculative positions are often closed or rolled forward. Unless strong structural signals such as persistent backwardation, sharply rising lease rates, or confirmed delivery settlement failures appear, declaring systemic market breakdown would be premature. Commodity markets often experience temporary stress periods that later normalize as liquidity conditions improve. Open interest dynamics provide valuable insight into market positioning. If price declines while open interest also decreases, it usually indicates widespread position liquidation. If price falls while open interest increases, it may suggest that new short positions are being added to the market. During expiration cycles, contract rolling can temporarily reduce visible liquidity. When market depth becomes thin, even relatively small trading orders can create disproportionately large price movements. This phenomenon is related to market microstructure effects rather than fundamental supply shortages. Such mechanical volatility may appear unusual to casual observers, but is often consistent with futures market operational behavior. Understanding open interest movement is important for distinguishing between sentiment-driven price action and structural market stress. Backwardation is sometimes considered a signal of short-term physical supply tightness in commodity markets. However, persistent backwardation is usually required to confirm serious supply shortages. In severe scarcity scenarios, lease rates typically increase significantly and remain elevated for extended periods. Clearinghouses may respond by raising margin requirements or issuing risk management advisories. These actions serve as early warning mechanisms to maintain market stability. If such signals are not consistently observed, labeling price volatility as structural collapse may be scientifically overstated. It is important to differentiate between temporary market sentiment fluctuations and measurable supply-demand structural imbalance. Silver operates within a highly interconnected global market ecosystem. In addition to U.S. futures trading, physical and derivative markets in Shanghai and London also influence price discovery. Cross-market arbitrage activity helps maintain global price alignment. Although temporary deviations can occur due to liquidity differences, exchange-traded fund flows can significantly influence vault storage levels. Industrial demand particularly from solar panel manufacturing and electronic component production, adds another layer of complexity. Mining supply cannot respond immediately to sudden demand spikes because new production projects require years of development. Because of these multiple interacting forces, single-factor explanations are often insufficient for understanding silver price behavior. Market psychology plays a major role in commodity price movement. After sharp price changes, social and media narratives tend to amplify, increasing fear or excitement among investors. Confirmation bias often causes individuals to prioritize information that supports their pre-existing beliefs. Silver markets have historically experienced both explosive upward rallies and severe downward corrections. Emotional trading decisions can lead to significant financial risk if not controlled. Structured analysis and disciplined risk assessment are more reliable than narrative-based predictions. Long-term investors who follow systematic strategies generally perform better than those reacting to short-term volatility signals. Risk management remains the most important component of commodity investment strategy. Leveraged futures positions are extremely sensitive to short-term price fluctuations. Physical silver holders must consider storage liquidity and exit flexibility. ETF investors should understand fund structure and counterparty exposure. Mining stock investors face additional operational, geopolitical, and production cost risks. Each investment method carries a different volatility profile. Diversification across assets and disciplined capital allocation are practical methods for surviving commodity market turbulence. Emotional decision-making during market panic often leads to poor timing. In conclusion, labeling the recent silver decline as a structural market collapse would be premature without strong empirical evidence. Futures, market mechanics, liquidity adjustments, and macroeconomic changes can all produce temporary volatility. Silver's long-term price trajectory will likely depend on global inflation trends, industrial technology demand, and monetary uncertainty. Short-term corrections are historically normal in silver market behavior. A balanced, data-driven investment approach provides the most sustainable decision-making framework. Investors should avoid reacting emotionally to sharp price movements and instead focus on long-term structural indicators and risk tolerance levels. This is Noble Metals.